Okay, next question. With the NASDAQ lower than the S&P 500, does it mean it's more on sale and a good time to invest? Not necessarily. The NASDAQ tends to be much more composed of high-tech companies, and tech is where we saw kind of the most inflation from low interest rates. And so what does that kind of mean? So in the way investors value stocks is on valuation ratios. And a valuation ratio is essentially saying how many times current earnings am I willing to pay for this company? And it sort of serves as a shortcut to a much more complicated analysis that financial analysts do, which is, they'll forecast out, they'll model out like, this is the earnings stream I think this company can earn, and they discount it back to present value, which is kind of a core concept in finance, is this time value of money, which $1 today is worth more than $1 in the future. And interest rates factor into that calculation. So when interest rates are really low, valuation ratios are higher. And when interest rates go up, it forces valuation ratios down. So if, call it 2 years ago, everybody was willing to pay 40 times earnings for Apple, even if Apple's earnings stream has not changed at all, the simple fact that interest rates have gone from, call it near zero to 4% is going to whack that valuation ratio and subsequently Apple's share price. So, and I'm making this up off the top of my head, but let's just say if 2 years ago people were willing to pay 40 times earnings for Apple, maybe today they're only willing to pay 25 times earnings. And so that can cause price compression. In addition to that, you're also, because of the potential loom of a recession, you're seeing also impacts to what that earnings stream looks like as well. I would say, due to recession concerns, as well as like supply chain concerns that have impacted like chip shortages and production shortages, all of that has had a negative impact on earnings as well. So you kind of had like a 1-2 whammy. You have a hit to valuation ratios and you have a hit to like the forecasted earnings stream. And both of those things have a negative impact on share prices. And so in tech, you've kind of seen a more severe hit because they had higher valuation ratios to begin with. And so that is why you see the NASDAQ down so much more than the S&P 500 or than like the Dow 30, which is, really high quality, large cap blue chip stocks, which are they're more, I kind of liken it to like the tortoise and the hare, right? So if tech is like high growth, it has higher volatility. It's got higher highs and lower lows, but over time has the potential to generate higher returns. But you have to be willing to stomach that volatility, those ups and downs along the way. So that's why tech is down so much more than the S&P 500 or like a value index. It doesn't necessarily mean that it doesn't deserve to be. It was also the most inflated potentially when interest rates were really low. And so that's why you're seeing that. But in general, tech is going to be more volatile. It's going to have bigger swings. It's going to have higher highs. It's going to have lower lows in these economic periods of volatility. So I don't know if that answers your question, but I hope it at least gives some color to understand like what's going on and why tech is down so much more.